Hello everyone, I'm Nova Lui, RHB Bank's Head of Investors Advisory. I'm honored today to have with us Mr. Tai Hui, Managing Director, the Chief Market Strategist for Asia based in Hong Kong. Mr. Tai has more than 20 years of experience in this industry. He formulates and disseminates JP Morgan Asset Management view on the market, economy, and investing to financial advisors and investors in the Asia region. Mr. Tai also regularly appears on international and local financial media, including as a guest host on CNBC Asia as well as Bloomberg TV and Reuters TV. 2022 has been a challenging year with S&P 500 down by almost 15%, while MSCI Asia ex-Japan Index was down by about 16%. Asia Pacific and Chinese equity market played a late catch-up by major recovery in the equity market from November until end of 2022. As we start the year with relatively positive tone on investment market, can you share with us what is JP Morgan's broad asset outlook for 2023?
Well, first of all, I think briefly on the macro environment, we are worried about the potential slowdown or even recession in US and Europe. But I think that will actually trigger a more conservative monetary policy from the Federal Reserve and other central banks. So the hiking cycle is not quite finished, but we are approaching the end of the hiking cycle, which to me is important. But I think more interestingly, China has started to reopen its economy. Obviously, in the near term, infection numbers going to rise, but it does pave the way for a strong economic rebound starting in the second quarter, some of which could spill over into the rest of Asia. So in terms of asset allocation, I would say in the developed markets, we start with a slightly more conservative stance, a greater emphasis on fixed income, and wait for signals from the Fed about the end of the hiking cycle and also the economic turnaround. But perhaps on the equity side, we do think that the opportunity for Asia, for Chinese equities, both in the Hong Kong and the Chinese market, but also in the high dividend world, is starting to look really interesting.
Mr. Tai, inflation has been a big topic since last year, with latest inflation data still high but trending down. What asset classes can help provide resilient return in such an environment?
Well, when you have a high but falling inflation, typically what you start to see is that central banks will slow down their increase in interest rates, and therefore some of the high income assets will start to look more appealing. So, for example, if you look at the fixed income, it could be emerging market fixed income, it could be corporate debt. In our part of the world, you see often emerging equities, Asian equities, including some of the high dividend stocks, where they do pay out good dividends. That will also attract investors' attention. So, as you rightly pointed out, different inflation environment, both high and low, and different direction calls for a different asset allocation. But I think when you have a high and falling inflation, you typically see Asia emerging market assets, both in fixed income and high dividend stocks, start to look a lot more interesting for investors.
Dear investors, it is a very good opportunity for us to have Mr. Tai with us today. If you have any question for him, please feel free to put down your question in the comment box below. We will try to address them soon as possible. Mr. Tai, between the developed market equity and emerging market equity such as Asia, which one would you prefer more and why do you see opportunities in this area?
Yeah. I think if you start 2023, I would start with Asia and emerging markets. As we mentioned earlier, the US economy, the European economy is likely to experience a deceleration, really as a result of the aggressive increase in interest rates from the Federal Reserve, from the ECB and the Bank of England. So in the developed world, we think that corporate earnings is still likely to go through more downgrades. While it doesn't necessarily mean that the equity market is going to do poorly, but I think the emphasis is going to be back in Asia, where earnings expectations in many Asian markets have been conservative. You can see that 2022 was a year of relatively slow earnings growth for many of the Asian markets, but 2023, with China economic growth accelerating, potentially benefiting many Asian companies who are in domestic demand or in the service sector, I think that will be, to us, a more attractive option, at least for the first half of 2023. Now, in terms of sectors, again, in Asia, we've seen a significant challenge for exporters, and that could be in semiconductors, that could be in consumer electronics, for example, represented by markets like Taiwan and South Korea. But with the China market reopening, I think a lot of the domestically focused companies are likely to benefit more. And sector-wise, that will be financials, that will be consumer, that will be real estate, shopping and rental. I think that would be the area where we could see some strong performance in the new year.
Okay, Chinese equity market has a massive rebound from November last year. Both Hang Seng and Hang Seng China Enterprise Index are both up by almost 30% since November 2022 to December 2022. A lot of our investors are thinking of riding on this risk-on mood. But do you see any risk of pullback in the first quarter of 2023 before it potentially go higher for the rest of the year?
Well, I think there's always a risk of a consolidation in the market after such a strong performance, as you rightly pointed out. But if I take a 3 to 6 months or even a 6 to 9 months view on the Chinese market, I still feel relatively optimistic. First of all, you can see that the valuations of Chinese equities, both onshore and offshore, continues to be consistent with long-term average, so they're not overvalued or too expensive. That's the first point. The second point is I think the market is still underestimating the opportunity or the potential for the market or for the economy to recover, especially on the consumer front. That could lead to some upside surprises in corporate earnings. The final point I would bring up is I think the rally since November, December we saw last year, that's largely driven by Chinese investors, Hong Kong investors, some Asian investors. We've yet to see US and European investors participate in this rally. So from a positioning standpoint, many of these international investors have yet to return to China. So I think once we get through Chinese New Year, once the macro data start to improve, that should provide more evidence that Chinese earnings growth is likely to recover. And that should attract more US and European investors to return to the Chinese market. And that could provide a bit more of a momentum to these markets.
Mr. Tai, as we know that the recovery in the Chinese equity market is mainly contributed by the China reopening story. But if you can deep dive into this, would this reopening actually benefit China more, or would it benefit other markets such as global market or Asia Pacific market more? What is your thought?
Well, I do think that the recovery is going to benefit China most. After all, China has gone through, almost 2 years of economic slowdown. So since the pandemic started in 2020, China was quick to get out of the pandemic and recover in 2020. But in 2021, we've had a series of policies and also challenges that led to weaker growth. And then in 2022, the very stringent lockdown have put even more pressure on the Chinese economy. So from that perspective, we do see a lot of the households, they've actually saved up a lot of the income in the past few years, just in case for rainy days. And that savings is likely to be unleashed, likely to be spent once the economic situation, once the job market starts to look better. So I think that will obviously directly benefit the Chinese economy. But I think if I look at more broadly, Asia is likely also to be a beneficiary of this demand as well, because after all, many Asian economies, for example, in Southeast Asia, in Taiwan, in South Korea, even as far as Australia, China's contribution to their export growth historically has been very significant. So the last 2 years where China's growth has been decelerating, many Asian economies felt it very much. But now, while US and Europe are decelerating in the demand for Asian exports, China is likely to accelerate, to pick up. And that, to me, will benefit many of the Asian exporters, or at least partially offset that weakness from US and Europe. Of course, the other obvious candidate is tourism. You can see also that, if you look at, for example, ASEAN, Southeast Asian economies, their tourist arrivals are pretty much 50% back to where they were before COVID pandemic started. So that means there's still enough 50% of recovery to go. And a big part of that is going to be Chinese tourists returning to popular destinations such as Malaysia, such as Thailand, such as Singapore. And that, to me, will provide additional growth momentum to a lot of the Asian companies. So I think from a beneficiary standpoint, China obviously is going to be the biggest beneficiary, but I think a lots of Asian companies that serve domestic demand and also serving Chinese tourist demand, they will benefit. For Europe, for the US, it's a much more company-specific situation where, for example, many European luxurious brands may benefit from China recovering. Many European automobile brands may also benefit from recovering, but it's likely to be less obvious and less concentrated compared with ASEAN or many of the Asian economies.
Okay, still on China, as investing into China has been a hot topic recently, can you share your thoughts between China onshore and China offshore? Which one is your preferred market?
Well, the China offshore market, especially in Hong Kong, has significantly outperformed in the latest round of rally. But that's partly also because the Hong Kong market has fallen by a much bigger extent in the past couple of years. So in a way, there's a bit of a catch-up going on. I think going forward, there are a number of areas to think about. Number one, if you think purely from a demand recovery play or different a theme, then the A-share market offers a lot of opportunity because the composition of the onshore market is a much more domestically focused, domestically tied companies that are listed in China. In Hong Kong, there are lots of banks, lots of tech companies. I think they will benefit, but they are likely to be expanding or improving at a slightly slower clip. But ultimately, it's not about A or H or onshore or offshore. It's going to be about which companies will benefit the most from this recovery, especially relative to the baseline of poor earnings in the past few years. And I think there are both opportunities in Hong Kong market, but also in the onshore market. So this becomes a much more of a sector and company specific question rather than simply should I allocate more of my assets in the market or the Shanghai Shenzhen market.
Dear investors, if you have any question on Asia Pacific or China, please put down in the comment box below. We will get Mr. Tai to address your question soon as possible. International Monetary Fund has recently openly announced that there is mounting evidence that US can avoid recession this year and achieve a soft landing for its economy. As the saying goes, when the US leads, the world catches a cold. If US unfortunately is in a hard landing recession, how would this impact the Asian equity market, Mr. Tai?
Well, I think if you have a hard landing in the US, that will obviously translate into a much weaker performance in US equities. And by default, we are likely to see similar repercussions in many of the Asian markets. Now, we may not feel as much pain as the US, partly because for some markets like Taiwan and South Korea, they've already gone through that harsh correction in 2022. For other more domestically focused economies like China, like Southeast Asia, like India, that depends on their direct exposure to the US economy. Again, you can see here that a lot of the Asian economies are now more dependent on China rather than the US or European market. So absolutely, from a financial market standpoint, from a risk appetite standpoint, a hard landing, a sharp recession in the US, a hard landing in the US is likely to create pressure on Asia. But at the same time, as we discussed earlier, the Chinese reopening story will provide some offset, and that to me could help to cushion some of the blow. I think the other thing to think about is if you think about investing in Asian equities, there are many Asian equities with a relatively high dividend payout. Now, while obviously there could be some pressure on stock prices, the dividend payout is likely to remain largely stable, and that will, again, provide some offset to the overall return proposition for Asian investors.
Okay, this comes to my last question. Given the more optimistic outlook for Chinese equity market or to a larger extent the Asia Pacific equity market, is it still a good time to invest into dividend stocks? Wouldn't it be better to invest into growth stocks instead?
That's a great question. I think it's not about either or. It's about how you mix and allocate between growth and high dividend. As we mentioned earlier, the high dividend stocks typically have a slightly lower volatility, but also a higher overall return over the long term. So from a risk-adjusted standpoint, high dividend stocks does play a quite an attractive role from that angle. I think the other thing to think about is that in a post-recession environment, so we discussed quite a bit about what happens if the US run into recession, but more importantly, the post-recession, the recovery phase typically represents the best opportunity in delivering return from equities, whether it's US or Asian equities, over the different phases of the economic cycle. So I completely understand that when we think about recession, we think about the downside, uncertainties and risks. But at the same time, we should be looking ahead and looking forward to that recovery. And again, high dividend strategies in Asia typically provides a very strong return in a post-recession environment. And at the end of the day, a lot of Malaysian investors, a lot of Asian investors, they're already heavily positioned in growth stocks. So the question then becomes, should they actually allocate some of their cash right now into high dividend plays in order to complement that growth strategy, which I think, is not just about picking the winner and there's only one winner, but it's about portfolio construction that can provide a better risk reward to investors over the long term.
Thank you very much for your sharing today, Mr. Tai. I trust this provides a better insight to our investors to make informed investment decisions. Dear investors, we have just recently launched RHB Asia Pacific Equity Dividend Fund in early January 2023, which fits into JP Morgan Asia Equity Dividend Fund, the Target Fund. The Target Fund aims to provide income and long-term capital growth by investing primarily in equity securities of companies in the Asia Pacific region, excluding Japan, that expects to pay dividends. If you look at the table here, investing into Asia equity dividend provides favorable upside potential and protects on the downside, which capture a smoother ride for investors' portfolio. My MSCI Asia Pac ex Japan on the up years offers 17.6% return, while Asia equity dividend strategy offers 11.3% return, which participates 64% on the upside potential. But in the down years, MSCI Asia Pac ex Japan broad market down by 8.7%, where Asia equity dividend strategy only down by 1.9%, which only participate 20% of the downside. This is a strategy that investors can consider as a part of your portfolio. Thank you very much for joining our Money Chat today. Please visit RHB Merge website to view other podcasts and Money Chat series. Do approach your relationship manager to know more how to rebalance your investment portfolio and to see how RHB Asia Pacific Equity Dividend Fund may potentially be suitable for your investment portfolio. See you again in the next Money Chat series.